Okay, so today we look at a general overview of the types of insurance that we're going to be covering. This particular slideshow does a great job of, of giving you an overview and understanding of insurance. And most of the topics are already covered in the chapters that we're going to be looking at here. So it's a good overlap. So, why is it important to have insurance in the first place? Well, because there is a chance of loss. Um, and certain, what we're looking at for risk are things that are beyond our control, that are not, that happen by chance, right? So things that happen by chance that cause losses. Well, you may own property like a house or a car. Well, by chance, of course, that's not on purpose, but by chance, you could get into an accident and that asset could be ruined. You could also cause damage or get damaged with that accident, and that would cause a loss of your health as well. Your house could get struck by lightning and burn down by chance. It's not something that's that's planned. So insurance is meant to cover the risks that happen by chance. The risks result in a loss. So the loss of property, for example, but it could also be the loss of income. So you could be, by chance, you could become disabled, and disability doesn't necessarily mean, the dramatic, being stuck in a wheelchair and can hardly move. It simply could be something like carpal tunnel syndrome, which is more common today than it have been because of our use of the keyboard in computers. And it usually affects the tendons and stuff in your hands, which means your hands are not usable all the time. That results in a disability. Well, if you can't use your hands, it's very hard to say you could work. And so that disability could result in a loss of income. And that's basically the risk. Those things happen by chance. You don't deliberately hurt yourself. These things sort of happen. And so disability insurance helps to protect against the loss of income by something that's unforeseen and unplanned. The same thing, I mean, we have a life expectancy of some 80 years these days, a lot more than that in many cases. So we are planning to have a full work life. A lot of us take on a lot of financial responsibilities when we're younger. Some people will have families and have children. They'll get a house. They'll get other types of things where um, they are the main source of income to provide their family with a certain standard of living. Well, by chance, some people die early, you know, um, even though we are hoping to last at least 80 years or more. Some people pass away quite unexpectedly sooner. Well, that's a risk. There's a chance of loss to your family if they depend on your income to provide them with housing, to provide them with other types of things. If you were not there, it would create a huge loss. And that's what life insurance covers, that type of risk. Um, so, all of the risks we're talking about have to deal with losses that result by chance. By chance. The only thing insurance works about is pure risk, things that happen by chance. Um, Speculative risk is not covered by insurance. And so just because losses can occur from other events. So you can put money in you can, sell your house and buy all types of lottery tickets and thinking you're going to win and you lose. Well, you had a chance to win. So it's not pure risk, it's speculative risk. Same thing, you can borrow a ton of money or get a bunch of money and invest in the stock market and lose all your money. Well, that's a speculative risk. There's a chance you also could have gained a lot of money, right? So that's not pure risk. Insurance deals strictly with pure risk, okay, things that cannot be controlled. And so, how do we cover this as individuals? Two ways. First, losses do occur from a lot of different things. We need to have some savings to help cover certain losses in case emergencies do happen, such as a car accident or being displaced from your home because of a fire that broke out, what have you. Um, it could not even be it could be by chance your neighbor's house caught on fire and the wind blew the fire to your house. That's certainly unexpected, right? Well, those types of things do happen, sadly. Doesn't happen to a lot of people, thankfully, but it does happen. So again, we need a little bit of savings. And then of course, that's what the other portion is. And the focus is we need insurance, which is a product that we purchase to help us mitigate the risks, right? To help us protect against loss. Okay. And basically what we're protecting against is really large losses. Sometimes it's hard to protect against smaller losses. And that's what the savings are really there for the smaller stuff. But some losses can be quite big, and that's what insurance is supposed to cover. Okay. So some terms that you need to know. An insurance policy is an actual contract. It's a contract between you and the insurance company. And it does state specifically what is the coverage that you're purchasing. What is the insurance coverage that you're purchasing? That's your policy. Okay. Coverages are about the risks that you want to have covered by the insurance policy. The more risks you have covered, the more money it's going to cost because the risks are higher. Right? And so this is part of what happens when you are negotiating. Some people say you can save a lot of money with this insurance versus that insurance. Well, it depends on what it's covering, really. I mean, the more coverages you have, the more risks you want covered, the more money it's going to cost you, because more things are being protected by the policy. And so, in the chance that it does happen, you know, you're covered. And so that's a big part of what's happening. You are the owner of the insurance policy that you're called a policyholder. And it is, in essence, viewed as an asset. Prepaid insurance is an asset for people up front. When you use it over time, it goes down in value. The money you use to actually buy the policy, that's what a premium is called. So all insurance policies have prices, and the price is the premium. Okay. So those are some important terms when you're looking at insurance. Okay. Some experts think that buying insurance is buying financial security. Is it true? Why or why not? Well, this is important to understand. It might not necessarily be a full security blanket, but a lot of people feel as though having those risks covered is better than not having the risks covered. Just because you ignore a risk doesn't mean the risk isn't there, right? And so, and I think we'll get into that when we talk about the auto policy. A lot of people are like, well, I don't need this much insurance. I don't need that much insurance. Just because you don't see the risk as important doesn't mean that the risk goes away. And some people that don't want to have any insurance on various things are assuming the entire risk. So, that's one of the issues. If you want to assume all that risk, then if a loss occurs, it's on you. So in essence, insurance does provide more security financially than not having insurance. So here's how insurance works in essence. Okay. Suppose there are 100 people that are in an health insurance group. Okay. There's a 1% chance. So there's 100 people in the group. There's a 1% chance that one of these folks can get sick badly enough to need $10,000 worth of medical care. See, the reason why it's a pure risk, and let's say you're one of these 100 people, you don't know if you're going to get sick or not. It's not something, these things happen by chance. They really do happen by chance. And so what if you happen to be the one in that group that needs medical care that costs a lot of money? Right? So you don't know who's going to get sick, but you know there's a slim chance, a small chance any one of you could be sick and need money. Well, everyone pays a premium. When they buy into the policy, they're paying a premium. And so insurance works as a pool. It's a sort of how a pool works. You're going to learn about that too in mutual funds. Mutual funds are also pools. Um, and basically, that pool collects premiums from all 100 people who buy the policy, and they have that money there to cover the people who get sick. So everyone gives up $100 to have the coverage of 10,000, but no one loses more than the $100. So yes, there's a cost to it, um, but again, you really don't want to use your insurance policy. You don't want to be the one who gets sick. You don't want to be the one who gets into an accident. You really don't want any of that stuff to. That doesn't mean the insurance premium you paid is a waste of money. Because if it was you, boy, you're going to be happy that you have insurance. But in the case that it wasn't you, then that's good news. You don't want anything bad to happen to you by chance. So you do give up some, but you never lose more than what you give up. And of course, the benefits cover a lot. So 99 people out of the 100 aren't collecting anything, but at least they had that peace of mind that if they were the one who got sick, they would have the insurance coverage to help them manage it. So this is basically how insurance works. Okay, this is basically how insurance works. There's, everyone has a common stuff going on. There's a small chance that it could happen to you, but you don't know for sure if you're the one that stuff's gonna happen to. So you purchase a portion of that to get the coverage. You have to give up something, but if you're the one who bad luck strikes, you'll be covered. So this is the purpose of how insurance works. Okay. So in essence, if you did not have insurance and you got sick, you're kind of stuck with the bill. You didn't want to give up $100. Okay, well now you got to give up $10,000. So in essence, we're shifting the risk from us as individuals to the insurance company, the pool of insurance holders that the insurance company has. And that's basically how insurance works. In most instances, the insurance industry and this particular illustration of insurance works fine. It's been doing it well for auto policies for most homeowners, with the exception of catastrophic stuff like hurricanes. The life insurance policies have been working quite well. Where this doesn't work well is health insurance. Health insurance doesn't work all that well. There are many problems with this model regarding health insurance. Well, we don't know if it's working well or not because there hasn't been enough time that's gone by, is like long-term care insurance. We don't know if that system's going to work the way it was designed because we don't have enough data yet to suggest that it's working. So this is how insurance works for everything, but it works better in some areas than others. That's what I'm trying to say. Okay. So the benefits of having insurance is that if you, by chance, something bad happens to you, well, then the payments that the insurance policy covers for you really is better. It far exceeds the amount of money you paid for the policy. Okay. And so, in that sense, there's a lot of benefits to shift that risk. If you didn't shift the risk, you still have the risk. See, this is the thing a lot of people don't get. They say, well, I don't need insurance for this. Well, okay, what you're saying is the risk is there, but I'm going to assume it because I don't want to shift the risk to the insurance policy. Okay, that's what you're saying. Of course, everyone needs insurance for all types of things because the risks are there for everybody. But people like to assume a lot of stuff, and so that's part of the problem. The types of insurance that are covered in this PowerPoint slide are also covered in our textbook. I focus a lot on chapter 10, which talks about property and liability insurance. I think this is the one that all of us have in common, the need for property and liability insurance, because a lot of us have automobiles or we drive automobiles that there's an insurance policy on. You need to know what that is. Many of us are renting an apartment, and so there's renter's insurance. There's liability. Even if you rent, there's still liability. Some of us own a house or like that. Well, there's liability and property insurance that needs to be done there. What we will touch upon, so we're going to spend most of the time in the next couple of weeks on property and liability issues because they affect everybody. We will get an overview of health insurance, of life insurance, of disability insurance. Long-term care insurance is part of the textbook. I don't cover much of it because it's one of those things, it's a system that's really unproven to this degree, but it is covered in your book a little bit. I just don't really cover it much for us, but I do cover auto and home, health, disability, and life insurance. I just focus on the property and liability, which is auto and home. The best outcome is always to be protected. And of course, never collect on it, because if you're collecting on insurance because something bad happened to you or your house or your car. So again, it's supposed to mitigate the risk by saying, if this ever happened to me, I wouldn't be taking a huge financial loss from this stroke of bad luck. Because you just never know what's going to happen. You might be a great driver, but there could be someone crazy on the road who hits you. That's not your fault. You didn't foresee it, but you want to be protected in case that does happen. Why? Because it's a risk. It happens. You see it on the news all the time. So it's one of those things where, these are real risks, and you need to think about coverage. Otherwise, you assume the risk. All right, so what happens with insurance and how it actually works? Well, first of all, a loss has to occur. So something terrible happens to you and a loss occurs. That could be someone hit your car. It could be, you were diagnosed with a disability that affects your ability to work. You can't work full time anymore because of of something that happened. So an event happens, and that event creates a loss for you. Okay. Well, then if you have insurance, you will put in what's called a claim. You will inform the insurance company that this loss occurred and provide appropriate documentation of that loss. Okay. So again, a claim is a formal request that you ask for payment because a loss occurred to you. The next step is the insurance company then looks at your policy and looks at your loss to see if it's one of those coverages that you have. Again, when you buy an insurance policy, you're buying certain coverages. So again, if it's covered by the policy, they can process your claim. If it's not covered by the policy, they will say this particular loss is not covered by the policy. Well, if it is covered, which in most cases it would be, generally speaking, there's always exceptions. For auto policies, some people will decide to have a deductible. And that means that before the insurance company pays for the loss, you have agreed to pay a certain amount of it yourself. That's what a deductible is, an agreement that you have decided that I will take care of this portion of the loss. And the reason why people like deductibles is the higher your deductible, the lower the premium on your policy is. The problem is the higher your deductible means you've agreed to accept payment of the loss up front before the insurance company pays their share. So I never have a deductible higher than, I even hate $500 deductibles. I tend to have 200, $250, $100 deductibles because I just don't want anything coming out of my pocket on an insurance claim. If something bad's going to happen, I don't want to deal with it at all. A lot of people like large deductibles. They'll have $1,000 deductible or a $2,000 deductible on their car insurance. Well, which means if anything does happen to your car, you've agreed to pay the first $1,000 or the first 2,000, depending on how your deductible is. The insurance company will then pay the rest. In cases of there's no co-insurance for auto policies, but there is a co-insurance for healthcare policies. And again, in addition to a deductible, healthcare has both deductibles and co-insurances. They're very complex. Auto policies, homeowners policies will just have deductibles. In many instances, the only way you have a co-payment, which is co-insurance, is usually because you have a healthcare policy that asks you to pay a portion of that up front when you see a doctor. So that's called co-insurance. So you pay a percentage of it or a particular amount. Same if you have drugs. If you have a drug benefit, oftentimes they'll say, well, you're going to pay the first $10 as a co-payment. It's co-insurance. Okay. So those are just some terms that you've heard about. Let's take a look at an example. Poor Louise. Louise has a health insurance policy. And this health insurance policy has both a deductible and a co-insurance, copay. So a $500 deductible means that she has to pay the first $500 of the claims of any losses. Co-insurance or co-payments means, in this case, it's a percentage. You got to watch out for those. In this case, she's got to pay 20% of the rest. So it's not ideal for sure. So let's take a look at how it would work out for Louise. So what if she's in an accident and she has a $5,000 medical procedure that's covered by the insurance? Well, this is the claim. Your insurance, the hospital will send a claim to your insurance company saying this is the loss for Louise. She had this operation, $5,000, blah, blah, blah. Well, the insurance company is going to say, okay, well, Louise pays the first $500 of this. Then she pays 20% of the rest. So in essence, Louise has to pay the first $500, which means of that 5,000, we're down to $4,500. And then she's got to pay 20% of that. So she's going to end up paying $1,400 total for the medical procedure, and the insurance company will pay the rest. Okay. Now that's because she has a very, very high, and again, this is a percentage, a very, very high co-insurance. Policies for healthcare today usually have a dollar limit, not a percentage limit, except Medicare. Medicare is 20% co-insurance, which is something why seniors have all that gap insurance that you might hear a television ad about AARP, policy that you want to get, blah, blah, blah. So it's because that 20% is pretty large, particularly if you've had a stroke or a heart attack where you need huge, operation. I mean, you're talking $100,000, $200,000, $300,000 bill from the hospital for those types of things. 20% of that is just, you know, not enough. There's not enough money most people have to cover that. So they'll have these gap policies to help them with that. But this is basically how it would happen with Louise. So even with insurance, she still needs some savings because she has a deductible and a copayment, co-insurance. Again, in many cases, the co-insurances are for healthcare today are not percentages; they're dollar amounts, and thankfully, they're usually reasonable dollar amounts. They're not outrageous. If she didn't have any insurance, and this has happened, a lot of people don't have medical insurance, but and it's gotten worse in the last 4 years. But basically speaking, what happens to people who don't have medical insurance, but they have a medical issue? They go to the hospital, right? Usually in an ambulance. They can't pay for the ambulance. Ambulance is a separate charge, but ambulance rides can be a lot of money, $500, $1,000 for an ambulance ride. It makes Uber sound really good, but and then, of course, the hospitals are required by law to save lives. They have to do whatever they can to save people's lives. It's the law. Otherwise, they can be liable for that. So the hospital has no choice but to expend the money to save people's lives for people that can't pay because they don't have any insurance. Those folks do get a bill, in which case they just say, I can't pay this because I'm working part-time, or I'm working for a place that doesn't have health insurance and I can't pay it. Well, that means the rest of us are paying because the hospital is a business organization, and it basically asks people with insurance to pay more to help cover those without insurance. So we are paying one way or the other. If the Affordable Care Act gets struck down, we'll be paying more. We'll be paying more, at least because the Affordable Care Act, at least for the years that it was first put in, it forced people to pay into the system, which meant you and I, if you and I already had insurance, we were paying a little bit less. Once they take that away, if in case they do, we'll be paying more. So more healthcare costs for those that already have insurance to help pay for those that don't have health insurance. So it's a big problem. And that's why I don't really cover a lot of health insurance issues in this class. It's just it's a topic in and of itself. It can be lasting all 15 weeks if we really wanted it to. But it's complicated. It's really complicated. So let's do the math here. Poor Carlos was involved in an auto accident, and it ended up costing, it resulted in $3,788 worth of damage to the car. All right, so what's happened? Let's take a look at his policy. So Carlos has a auto policy, which is property and liability, that has a $500 deductible. And of course, auto policies don't have any co-insurance. They just have deductibles. So what would that mean? Well, that means that Carlos pays the first $500. In other words, Carlos has to pay the deductible up front. That's what a deductible is, the payment you decided to make up front if something happens. So Carlos pays the first $500. The insurance company now pays the rest. Okay. So again, we're still sharing the risk to some degree. When you have a deductible, you have agreed to share the risk. The reason that people they don't like to pay a lot for their car insurance policies, so they keep increasing the deductible. Well, basically, they've just put more of the burden back on themselves, right? So if something terrible does happen, it's going to cost you more money up front before the insurance company is. I mean, why bother having much insurance at all if you have a $2,000 deductible? I always keep those really, really low myself because I don't want to. That's the reason I'm paying for insurance in the first place, is to shift the risk over to the insurance company in full. So if something happens, I don't want to pay any more out of my pocket. I'm already paying a lot for my premium. Um, and unfortunately, a lot of people do play with their deductibles, but this is the ultimate thing. It's how much you pay up front before the insurance company pays on any claims that result in damage to, in this case, a car. Right? So it's something to be careful about. So here's an illustration where Janet has a couple of things to worry about. She's looking at insurance policies. In this case, she wants a health insurance policy. Her current policy is listed here in the first column. There's another policy that she could get if she wanted to. Well, here is some more information. The premium per month. So the current policy, she pays $300 a month for her current policy. If she wanted the new policy, it would cost her $200 a month. The deductible is different. Her current policy has a very low deductible, only $200 is the deductible. The new policy would have a $2,000 deductible. Okay, she would pay. Now in health insurance, this is usually an annual deductible. So she would pay the most annually $200 additional. For the new policy, it'd be $2,000. But then the deductible is only one part. What's the copayment? Well, her current policy, she has to pay 20% of the rest of the balance. The new policy, she pays nothing. There's no copayment. In addition, so let's say she has a major surgery. She has some problem and needs a major surgery that costs $10,000. Well, under her current policy, she would pay $200 of that $10,000 up front. And then she would owe 20% of the rest. So 20%, I just tell you, rounding, 20% of 10,000 is $2,000. So she owe a little bit less than that. In the new policy, she would pay the first $2,000 of the $10,000 bill, and then she would owe nothing. Okay, so if it's just a relatively simple thing where it's a $10,000 operation in one cases, these policies balance out. What if it's a catastrophic issue? What if something terrible happened where she needed to be on life support because she got into a really bad car accident, or she needed, she had COVID and she needed to be in the hospital for, for many, many days. Well, then her new policy is looking a lot better, because in this case, the most that it would cost her is $2,000, regardless how long she was there. Whereas the current policy, yes, it's a smaller amount up front, but she'd owe 20% of the rest. And so the more days she would spend in the hospital, the bigger and bigger and bigger that bill would be. And 20% of a big bill is a lot of money compared to nothing, right? So as you see, there are pros and cons of insurance policies, particularly in this case, health insurance. The problem with this is, of course, you and I rely on our employers for health insurance. It's in our particular system, we're the only advanced country in terms of economics. I'm talking about all of Europe, Japan, Canada, things like that, South Korea. We're the only advanced nation, economically speaking, that we rely on employers to get health insurance. All other countries of the developed world, it's a policy that's provided through government. That doesn't make it. That doesn't make it socialized medicine. It's just the insurance policy is government run. The problem is, of course, if you can work for someone, you can be working full time for an employer who doesn't have an insurance policy. They don't offer health insurance to their employees. And certainly many part-time employees don't have any health insurance at all. So that's a big burden on U.S. businesses, and we're the only country that does that. And sadly, businesses use it as a benefit to attract you to work for them. And so, but it's the businesses that decide with the insurance companies what the policy is going to be about. Often you and I have no chance to pick our policy. It's different when you're dealing with auto insurance. You can actually go shop around at many different insurance agencies and say, this is the policy I need. What do you charge? You just can't do that with healthcare. Healthcare is somewhat predetermined by whoever your employer is and what they negotiated as a benefit for you. You have no say. There's no place to shop, so to speak. And because healthcare is very expensive, more and more employers are giving employees less and less choices. I think when I first started, there were at least 3, 4, 5 different insurance plans I could have chosen. Now there's really one. So it's one of those types of things where the choices have gotten less and less because the expense is more and more to the employer. Okay. So let's take a look at why, in essence, deductibles and copayments are part of insurance policies in the to begin with. Okay. Well, it's basically because of it helps deal with something called moral hazard. Okay. And this is a real issue. So, when you insure something because the likelihood it's going to happen is going up. So in other words, you're trying to use the insurer, the insured is trying to use the insurance to gain. And the whole purpose of insurance is not to gain, it's just to stop a financial collapse from happening to you from any loss. And so in essence, deductibles and co-payments put more responsibility on the policyholder to be careful. An example of moral hazard is provided here: not locking your car in a theft-prone area, right? Or parking it deliberately in a theft-prone area in hopes that it'll get stolen and you'll get a new car from the insurance company. That's moral hazard. You would, the idea that if you would have a deductible or a co-insurance would reduce the likelihood that you would do something like that. It doesn't eliminate it, but it does reduce the possibility. Yeah, there's a lot to talk about on that sometime. Okay, so again, the whole purpose of insurance is to just simply cover the loss that happened. And so it puts you back in the spot you were, or as close to it as possible before the accident occurred, right? So like the accident really didn't happen, didn't have an impact. That's really the purpose of the insurance, to cover those types of risks. It's not meant to make anybody rich. You're not supposed to profit from insurance. It's simply supposed to make you the same, keep you the same as you were before the insurance, or as close as possible after an accident. Certainly, we can, as individuals, buy insurance policies. And that's true for many types of insurance: car and homeowners insurance and renters insurance, life insurance, long-term care insurance. Clearly, there's a lot of insurances that you and I can actually buy ourselves by going shopping at insurance companies for them. And like I mentioned earlier, a lot of us rely on our employers for health insurance. Disability insurance is also very expensive to do it individually. So oftentimes we rely on our employers for that. Employers also are sources for life insurance policies for employees. And so you can buy it individually, but you can also, it's cheaper to buy it through your employer. And then, of course, we do rely on government programs to provide various insurance coverage, and that's one of the issues uh, that's been quite handy here. So today, with the COVID crisis, the whole idea of unemployment benefits, that's an insurance program. Uh, Unemployment is an insurance program. Um, the employers pay a small tax on every employee that they hire for wages, um, to the unemployment fund. And that's how government uses that to pay people who got laid off in a crisis. Um, so many government programs that we rely on are actually insurance types of programs. One of the things that you'll never get individually that is specifically a special program, particularly during catastrophes, is um, flood insurance. There's a lot of people that live in flood prone areas, and no insurance company in their right mind is going to insure that because you cannot predict the loss. And insurance is a business. And so it has to be able to predict certain things and be reasonably assured as a business model that it's going to be profitable enough to exist long into the future. And when you have billions of dollars of damage from one hurricane, and Louisiana had two hurricanes this past month, last month, it's no insurance company is going to do that. So the government actually has special insurance programs for folks that live in these areas in that regard. So we do rely on a lot of government related stuff as well. And most government programs are insurance programs: Social Security, Medicare, Medicaid. I said unemployment compensation. Those are basically all insurance programs that are run by the government. Okay, and I got a question. Yay. Yeah, well, they don't cover hurricanes regardless. Whether it's a superstorm or a really bad storm, they don't cover floods, even from just rainstorms that happen, flash floods. They don't cover that. Um, so it's just one of those things that it will not be covered by insurance companies because they just can't. They cannot in any way, shape, or form predict those types of things with any certainty, and thus they can't price the insurance policy well. Okay. Even when you get your insurance from your employer, it's a two-pronged system. Even if you're getting health insurance from your employer, you are contributing to that. Your employer is paying a pretty good amount for that, but you are also contributing. I can remember when my first job back in the 80s, health insurance was a free benefit. We got that for free. It was totally paid free for me, meaning it was totally paid for by the employer. Now, I have health insurance for my family, and the family coverage is roughly about $3,000 per paycheck. I pay, I think, about 300 of that. Maybe 350 of that. My employer pays the rest. It's a very hefty benefit, and that's every check. I get paid every 2 weeks. So you can just imagine what it's like in other companies. And this is one of the reasons why a lot of companies don't provide health insurance to their employees. It just costs a mint. It costs a ton of money. And it might be time to talk about government options for health insurance, because obviously employers are having a really, really hard time providing this coverage. And we're going to get it. There's really no other way to get it. So we are paying through our payroll, and the employer is also paying the vast majority of that. Okay. So this is a little note on that. Government programs. There's a lot of government programs that are very specific. So we have, again, Social Security is an insurance program. It insures people against poverty-stricken old age. That's technically, if you look back at when it was started, and you look back at when Franklin Delano Roosevelt signed it into law in the late 1930s, that's how we describe it. This Social Security measure will insure against poverty-stricken old age, because you don't want to work. Because prior to Social Security, and you lived until you were 70, 80 years old, you still had to work. There's no other way to get money, right? So at least Social Security provided some insurance for the older folks that needed money, but they were too old or too frail to work. Medicare is for everybody, every American. We do have universal health care coverage in the United States. It's called Medicare, but you have to be 65. The only qualification is 65, being age 65 or older, and you are on Medicare. Medicare is health insurance. That's a government program. It's not health care, it's health insurance. Medicaid is health insurance program, but in this case, it's income determined. Anybody can qualify for Medicaid if they are very low income. If you're old and poor, you can have both, Medicaid and Medicare. My grandparents had both. They were working poor, so they were Medicare and they were Medicaid eligible. But these are insurance programs. That's all they are. They're not anything other than insurance. Okay. Of course, government programs include unemployment compensation and insurance, like I had mentioned. So when you lose, it's a tax on businesses per employee. It goes into this unemployment fund. And so when companies start laying people off for things, the government has money to pay the unemployment claims that come in. Workers' compensation is a similar model. This is very specifically about injuries on the job, and it's an insurance. It's a tax that's paid from employers. It's required, and it only covers if you're hurt on the job. Only that. And then, of course, we have a lot of legislation coming for very special types of things, whether it's COVID related stuff, to help offset the costs of that for hospitals and individuals, or for Hurricane Sandy or other types of things. There are special programs because insurance doesn't, private insurance companies won't touch it. So government insurance is the only option, or no insurance at all. So, there's a lot of issues, and I don't know if all of these particular things are, I'm sorry, going too fast. There's a lot of issues regarding healthcare that, no, Adam, workers' compensation is for anyone who gets hurt on the job. So if you're actually at work and you get hurt at work, injured at work, that's what workers' compensation is supposed to help cover, the costs of fixing you up, so to speak. Some policies, depending, even provide for a certain amount of wages that are covered while you're out sick or recovering. It depends. Not all of them do that. Some of them do. So it varies. It does vary. I just want to say a little bit on the health insurance. So right now, like I was mentioning, we rely on our employer for health insurance. Again, we're the only country in the developed world that does that. The employers negotiate health insurance packages with the insurance companies. Say, look, I have 1,000 employees. I want to offer them health insurance. Let's negotiate what a health insurance policy would look like for my employees. And they negotiate that and they set prices. But it's really between the employer and the health insurance company. You have nothing to do. You have no role to play in it. And so you're kind of stuck with whatever the employer has negotiated for the benefit. Now, employers negotiate differently. So some policies cover more than other policies. Well, Obamacare, as the Affordable Care Act, basically said, look, there has to be 10 risks covered on every policy, period. And they listed all those 10, and I actually have something I can put up on the website for you after on what exactly is covered. But there are 10 specific risks that are covered, including, drugs and prenatal and mental health and things like that. Well, a lot of companies that negotiated with their health insurance didn't have those not all those coverages. Of the 10 coverages, they might have had 7, you know. Okay, it might have had 7. And so the Affordable Care Act forced those companies to go back and negotiate to get all 10 covered. So what happens when you go from 7 things covered to 10 things covered is it costs more. And I know people were up in arms about, the cost of it costs more, and I have to switch my doctor. That's really that really is about the health insurance company and your employer renegotiating the contract. So it didn't really have a lot to do with the law per se, as your employer and your health insurance company might have made different choices. Your employer might have even selected a new healthcare company, and thus you have to get another doctor. So it really had nothing to do, less to do with the law being passed than it needed to do with the negotiations between the employers who provided the benefit and the insurance company. And so those types of things really manifested itself in kind of weird ways. But it really was the problem that happened with a lot of people. But of course, for a lot of people, they got more benefits. So a lot of people were very happy with the coverages under the new Obamacare law that was passed. Okay, so I'm going to stop there for today because we've been going on for about an hour. But that's at least the first sort of overview of healthcare, of insurance, how insurance works, things like that. I'm going to finish that particular slideshow when I see you next time, and then I'm going to dive into more specific things about auto and homeowners. But are there any questions?